Welcome to the Broken Pie Chart Podcast, episode 339. I'm your host, Derek Moore. With me once again is Zega's own Shane Skinner. Shane, what's going on today? Besides Powell.
Besides Powell, this is a great way to end the week. So far, the August scaries have seemed to be avoided, and there's, I think, a lot to talk about, a lot to look forward to here.
Well, I mean, the NASDAQ was down 6 days straight, and then today kind of made up for that.
Yep.
Let's get right to Powell, though. So Powell gave a little talk in Wyoming, and they did the whole picture. They're out on the plains there, Wyoming. Did he say anything of substance?
I think he said one of the most pivotal things he said in the past 5 years, and in relation to Fed policy, the idea that they're going to adopt a model that does not worry about the 2% inflation target that was established post-COVID. They're now letting that go and adopting what sounds like a more free-flowing inflation policy, as long as employment stays where they like it to. So I think this is being overlooked. I mean, I like the market's reaction. I think the market reacted initially correct. Even if we get some pullback in the next month or two, what he just said with that is, it sounds like they're open to letting inflation run if it is hot. Whether it's here or not, that's up for debate. Some people don't even think it is, but at the end of the day, this sounds like it's going to be inflationary for assets, I think. But I would love your thoughts.
Why do you care what the Fed says anyway? I'm saying the you is proverbial like anybody. I mean, just think about how wrong the Fed has been and how difficult it is to give them the benefit of the doubt. It is to sort of decide where do they think the market's going to be in a year, where they think interest rates are going to be a year. So sure, they'll let it, sounds like they're willing to let it run a little bit. And, maybe it works, maybe it doesn't. This is the same Fed chair that said inflation's transitory, nothing to see here, didn't do anything. Now, I would say that the Fed raising rates didn't stop inflation. It didn't cause it. It was all the excess, sending checks out, the PPP, the stimulus.
Supply chain stuff too,
and the
right?
supply chains.
Yeah,
but think about this Fed. They didn't raise rates until employment was 9% CPI year over year. Why should I believe anything that they tell me now?
Well, it's funny that you say that, because I'm with you. I actually think what he just did, saying that, I think that's it. Like, I don't think there's really much credibility left, because it's sort of like, wait a minute, you've been freaking out over this whole time, and now all of a sudden you're just sort of adopting this idea that it is okay. Whether we are at 2% inflation truly, or at 5%, or wherever we're at with it, it seems like they're just behind the curve yet again. And
I mean, here's the reality, and we did this, I can't find it. Jay and I talked about this probably, I don't know, a year ago, where I looked and I said, since they put their inflation, their 2% target in place, which I think was it 2013? I could be wrong on the date. What percentage of the time were they actually plus or minus? I think it was, between 175 and 225. And it wasn't that much. It really wasn't. So, I mean, I'm going, Daniel LaCal on Twitter had this chart, and it shows the CPI, the year over year. And it was like no inflation risk, print. Transitory, print. Largely transitory, keep printing. Oops, hike and print. Hike. Hike, but print more. Like, they were still buying mortgage-backed securities as housing prices were going up and up and up. Like, why did they need that?
Well, what do you think they're about to do again? I think they're about to print their way out of it again. They're the only way to offset how much are we in national debt now in trillions? It's It's disgusting. Hang on, I'll pull it up. I have it here.
It doesn't. I don't even know that it
I
matters though.
but I mean, I don't think it does either. Having said that, though, um, I think they're just going to inflate the debt away. I don't think they care
It's not
anymore.
going away. It's not.
It's
It's
not.
impossible.
The
Like, here's
it's
the
not.
thing: when you've been doing this as long as I have, you get cynical, and the reality is, politicians like to pretend that the debt's important. They feign being concerned about it,
Yep.
but it keeps going up and up and up. And
Yep.
only when we had the tech boom in the late 90s, early 2000s, do we have a single year that I can remember where revenue exceeded expenditures because you had all the capital gains.
Yeah, I would also argue that that's not necessarily a good thing when you think about the system that we're in and how this works. That means more money was taken out of the system than put in. That doesn't necessarily bode well for the consumer, actually, like in the long run, right? If we were to have consecutive years of surplus, I don't think that would actually go over well in the long run, the way people think it would. That's not how the system's designed to work.
Look,
It's about
I
how
thought
we
it was a
put that
problem in the
capital
80s.
work, right? It's about how it, yeah, yeah, of
I
course.
thought debt was a problem in the 80s. And at some point, people will be right on the debt. And I will tell you, yes, it's a problem when it gets up to this much debt to GDP. When you're looking at net interest payments, the interest on the debt being greater than the budget for national defense, greater than the budget for entitlement programs or Social Security. So, all right, the bottom line though is, I mean, the market went up huge today. And the reason was is the market looked at what Powell said or didn't say, and basically he heard what exactly you just said, that yeah, we're okay if inflation goes a little bit. He hinted at being ready to get ready to cut rates again.
We're talking about.
We're talking about, we're getting ready to get ready. I mean, I would tell you that when they hiked, or not hiked, when they cut the two times, CPI was higher. Some of the other metrics were worse than they are now. So I just look, we'll see. Let's think about the interest rate projections though, and these are going to change. The probability of a cut in September, not 100%, but 81.3%. They do that. They come up with the probabilities based upon what the Fed funds futures are trading at. So then you look at the October 29th meeting, the first meeting September 17th, October 29th. There are 1.365 cuts expected. So basically, you have like a 55% chance that you'll have an extra cut. And then, I mean, basically, they have two cuts priced in by
Or if they
December.
don't cut SEP, they'll cut OC. I think
Yeah.
that's sort of where that lines up. And depending on, you mean you really got to think about it. It's all gonna be based on what he says too after the cut, right? And who knows? Maybe they cut 50 in SEP, and then they don't do anything through OCT. It'll be interesting to see that's chosen. But continue with the path here. I mean, it looks like, what are we pricing in by December of 2026? Um,
It's a point. It's a full point of cuts.
yeah, a full point. And I mean, you're talking about that's
Three
16
and a
months from
quarter.
now, 3.25. Yeah,
Yeah.
yeah, not bad.
Which probably is where the market is telling you rates should be. When you look at the
That, doesn't
2 year
that
yield.
sound
Yeah.
normal? Right, right. Based on 2 year and just sort of based on, I mean, even I don't know, 3.5 just sounds right around where we should be.
You
Three
should
two.
get paid less for tying up your money for a shorter term than 5 years or 10 years. And right now, although we're not inverted all over the place anymore, I mean, you should get a time premium. So it feels like the market is saying, will the market really, I mean, does it really make a difference if they cut 25 or 50 bips? I don't think so. I mean, Shane, I go back to the earnings, and in the long run, like, none of this matters. The reason why stocks have gone up is because earnings projections are up. If you look at, the forward, and then there's different ways of looking at this, the blended forward, something like 288.34 cents a share, $288 and change per share. And the S&P, that's the highest a forward, if you chart forward 12-month estimates, that's the highest it's ever been. And then you look at the forward PE ratio. It's, depending upon where you look, 23 and a half, 24. It just depends on whether you're using blended or strict. But look, I mean, earnings going up over time has a very good correlation with the stock market moving higher. And you have deviations above or below the long-term trend line. But Shane, I got to tell you, I mean, analysts say 7.8% growth over the next 12 months. And from month 13 through 24, another 12.4% growth. And then, month 25 through 36, another 10% growth. Like, earnings are estimated to grow. Whether they actually come in at those levels, I'll let you know in 12, 24, and 36 months. But that's why the market is doing well. And the market wasn't doing well in April because analysts reduced their forward estimates, and the multiple that people were willing to pay against future earnings dropped. Once the multiple reflated, once earnings expectations went back up, the market started going up again. I mean, that's the reality. And with or without interest rates, in the end, it's earnings that matter. It always comes back to earnings, Shane.
And wouldn't you say that that's the purest form of, it's justifying price? Is what is this business making or not, and what are they expected to make or not in the future, right? I think along with that, let's be real. And again, I am not taking any stance here. I'm just saying, you said it. It's the most hated rally in the history of rallies. This really is. And I think the longer people fight it, if these growth multiples continue in the direction that they're trending, if nothing massive happens, right, some black swan event that we just can't foresee, I mean, things look staged to continue as business as usual, it looks like, based on this at least. Obviously, like you said, we'll know more in a year whether this is right or wrong.
But. Yeah, I mean, and that's why, I mean, one of the core things we do is we buy and hedge, buy and buffer, not try and pick direction.
Yeah, because when can you predict when those estimates are going to get adjusted, right?
Well, or the multiple deflates.
I mean, because of earning, right?
Let's say we went to a 20 forward multiple. That takes the market to around 5,500. We closed today at 64, 67-ish. So that's the game. Like, when everyone's trying to make predictions, even if you knew the earnings, let's say these earnings are good to go, you don't know what the multiple is going to be. So I don't know. I mean, look, we have a high multiple right now. So to say that the multiple go to 30 is probably a stretch. Will it happen? I don't know, maybe. But it's less likely than the multiple either staying where it is, going a little bit higher, but you're already pretty stretched in the multiple. So yeah, if you get a multiple contraction, you can get estimates go higher, but the multiple pulls back.
I wonder how this sizes up relative to money supply in terms of multiple growth. That's some research for later, but I'm interested to see that wind up together. I mean, it's a beautiful chart. It's clear as day. And like you said, when the forward expectations reversed, it's almost instantaneous, the move the market makes with it. Yeah, I mean, it's hard to argue against this.
The last company that's going to report is NVIDIA. I think they are due the 27th to report, although that's subject to change. That's really the linchpin in this. So let's give the bull and the bear cases. NVIDIA comes out. They not only meet earnings, but they beat, and they also guide higher. And there's some sort of news about forward sales or new things that they can sell and this and that. If they miss, though, or even if they beat, but they start to pull back on their forward estimates or their margins, they think there's going to be margin contraction. I mean, that could be the fly in the ointment of the market. Like, that's the unknown. And That's a big deal. Now, we saw Taiwan Semiconductor report. We saw some of the other ones report. We know that the big, the Mag Sevens are spending capital on AI. So, but that's a big deal. Like if you ask me what could delay or what could hurt this rally, it's Nvidia right now. Like a lot
Absolutely.
rides on Nvidia.
Absolutely. I would also say though too, you've got a variety of names in the market this week that some pulled back hard, like Palantir, right? Palantir took a 20% dump in 24 hours at one point, and it didn't quite recover all the way back up yet. And yet you have this market basically back to all-time highs. And so I also think it's if there's that pullback, it doesn't necessarily mean that money's coming out of U.S. equities or the markets, right? It could just be rotation. And so I think you're right in the sense that yeah, that might stall growth initially, but at the same time, if you have the rest of the market this quarter, I mean, most companies reported pretty well, and the guidance, this tariff thing, it's still sort of like it's an unknown, and no one necessarily wants to get out in front of themselves and be uber confident. But I mean, listen to Home Depot this week or this past week. Um, After their earnings, they had great guidance. So it's I don't know. I think this market's a lot more resilient than people realize, and even if Nvidia were to come back down, that might stall the market a bit, like you said. But I don't know. This market seems like it's steady.
On the tariffs, it's so far we really haven't seen inflation. And I know the PPI came in a little hot. I talked about that last week, and go back and listen to that episode. And there's something called the trade PPI that's in there that's a little wonky, deals with margins. But I'll repeat it again. When you look at something like, I don't know, import prices, the U.S. import price index by end use all year over year, August 15th was minus 0.2% month over month. Like we're just not seeing it yet. And I know the Fed says, wait, it's coming. And look, I mean, I think Target or Walmart, there were a couple retailers who talked about tariffs and price increases, but at the same time, they had very good earnings. And I start to look at, and it doesn't matter whether it's tariffs or anything else, when you look at these earnings calls, the excuses come out, and the excuses for why we might take, our business might face headwinds, because you're setting up it wasn't anything that we did operationally. It was this. It was currency fluctuations. It was tariffs. It was something else. There's always a reason, and they put it in there. So far, we're not seeing it. We're not seeing it really hit inflation. I know the PPI came in hot. There's sort of some technical reasons for why that is. We're not seeing it yet. And Shane, the other thing I think you talked about is how hated this rally is. We see it. And, we manage not only we have individual wealth clients, but we also manage money for other advisors as a sub advisor. And we see it. We see people who say, you know what, I want to put a little bit of money in the market, and then I want a dollar cost average, or I want to wait till things settle down. And timing the market's really tough. But I will tell you, I think there's a lot of people who are sitting this out. There's definitely a lot of people sitting this out, Shane.
Absolutely. And I mean, I myself have been, you know, from time to time bearish, and not afraid to be vocal about it. But I said it earlier today. The more time goes by, I've come around to the realization that really buy and hedge seems to basically be almost like the underlying, like that's just what the market does. That's what the trade is. You buy and you hedge when hedges are cheap. And unfortunately, yes, we've seen people who sometimes, yeah, they've made the correct call on waiting, or adjusting on their, and their timing was right. But for as many people we've seen do that, we've seen just as many miss it, and it gets worse, right? You find yourself in a situation where now you got to buy something for more than you wanted to, right? Or you have to sell it for less. So at the end of the day, I just I don't. I don't know. Timing the market's really, really hard. Not many people can do it.
Well, do people want to be right, or do they want to try and invest for the long term?
Yeah, do
And
you
there are
want to make money,
situations,
right?
yeah. I
Yeah.
mean, there's people. We have advisors who we had something come up this week, and I think somebody had planned to use the money in a couple weeks. They said, "Should I wait? Is it better to do it now?" Or and it's like, well, look, if you're taking the money out in a couple weeks, I mean, that's not money that should be necessarily pressing the bets in the market, right? But yeah, so something else that I wanted to talk about too is this potential broadening in markets. And if you look at the equal weight S&P, it's up 7% total return year to date. The S&P SPY
Rotation,
up 9.09.
rotation. This market is so resilient. We have technology and liquidity mechanisms now that haven't existed in the past 10 to 20 years. As time goes on, I believe that fintech and these sort of liquidity solutions in the market will continue to grow and expand. And yeah, again, this going back to the Nvidia thing. Yes, if Nvidia takes a big hit, the broader index likely comes down with it for a little bit. Sure. But again, if that money is not leaving the market, it's going back in somewhere else. And so I actually hadn't checked on the equal weighted recently, and I'm very pleased to hear that. That makes me feel even more confident.
Yeah, I mean the spread. You would expect the spread there. I mean, you would expect.
Dow Jones was up 2% today. I mean, the S&P didn't even break 2%. I don't think. Maybe came close, but we didn't touch it. Dow did amazing today, and this whole argument of like growth stock versus value stock. I think that names, you get that label as a company, um, because of how you perform consistently. But at the end of the day, growth is where growth is. And so, um, names like TJ Maxx blew up this week. Just a incredible earnings report. Um, Stock has done phenomenal. And to me, most people don't sit there and probably think, oh, TJ Maxx, growth company, right? But at the same time, their margins are good, their forecasts are good. It's there's always something somewhere,
I
right?
got to be honest with you. I'm not following TJ Maxx stock, so uh, I couldn't even tell you what the
My
earnings are.
fiance absolutely loves it, and
All right.
unfortunately, if I would have listened to her, a year ago, where were we trading? We were a year ago on this stock 120 a share. We topped out at 145 this week, currently at 136. So, for TJ Maxx, not bad.
On Nvidia, a lot of people forget it had a almost 37% drawdown this year.
Hmm.
37% drawdown. Like
It's a
it's
lot of. It's
this is
huge.
why. And look, I don't know if it's expensive or cheap right now. If you want to buy it, you buy it. If you want to short it, good luck. Short it, you have unlimited loss potential. If you want to stay out of it, stay out of it. Like I don't care what you do with Nvidia. All I'm saying is when people go on CNBC and they say, "Well, I like the market, but I'd like it a lot cheaper." Like you had the opportunity to buy the market cheaper in
It
April.
was there, right? It
It was
was
right
there.
there.
I started in mid-March at Zega, right, and was
Hmm.
formerly at Schwab, and I can say with confidence that before I left, I jokingly said to guys, I was like, I love Nvidia at 90, and everybody thought I was crazy, just absolutely nuts. But I was like, man, if Nvidia hits 90, that's gonna be an amazing buy. And sure enough, April it hits, and a couple of buddies reached out. They were like, "How did you know?" And of course I didn't. Right? It was a lucky guess based on technical analysis. But seriously, I don't think you said it earlier, because I've expressed concerns. We talked previously about this one on one. Is this 2000 all over again? Because I wasn't around for that, right? And I can obviously go back and dig through the data, but at the end of the day, I didn't live through that. So I just don't
You know how I
feel
answer
like
that? I
you
say,
said those companies didn't have earnings. These companies have earnings. It's that you said that's the biggest difference, if
well,
I
you
remember
know
correctly.
the answer to this, but what is the most highly weighted company in the Nasdaq 100, the QQQs today?
Nvidia,
Nvidia. What was the highest weighted company in March of 2000 in the Nasdaq 100?
Cisco,
Sirius Satellite
or
Radio.
Sirius. Sorry, Sirius wasn't Cisco.
It's not the same market. It
No,
really isn't.
no.
There's people have heard me tell this story before, but there was one day, I forget, it was like a penny stock. And there was a period in the late 90s where anything would change their name to .com and it would just go up. So there's this one day, it was pinkmonkey.com. You can try and find the stock. And literally it started to run and all these people are calling the trade desk wanting to buy pinkmonkey.com. One of the guys on the trade desk found the number for the company and called them, and somebody answered hello. It was like a Cliff Note bookstore, and the stock went just nuts. Literally, they were selling it like Cliff Notes. I don't know if you know what those are, but it was a yellow book. Like you didn't want to read War and Peace, so the Cliff Note version was a
It's
condensed, like
basically a summary. So
what
what
ChatGPT could do
was
for you for free.
Yeah, yeah,
Yeah,
Spark
exactly.
Notes back in
But
when
those are
I
the
was in
companies
school.
that were running, and even when you look at like GameStop, you look at AMC, some of the meme stocks right now, it's nothing like it was back then.
No, no, and
You were
those
buying
names
air,
aren't
literally
right.
air.
the
It
the
was
the big players have grown so much bigger relative to those smaller kind of names that we're now in a market where names like that can run up and run down, and it's probably not going to have an effect on the broader market. The Russell might not do as well, but the S&P 500, I don't
well
think it
the
really
Russell
cares
though
what
is
those stocks do.
Shane. The difference with the Russell now and back then though was so a company like I don't know, Tesla or Uber or not Tesla, like you used to have these nascent early stage companies, like they would be in the Russell 2000, and now those companies stay private. Like they do more funding rounds private. They don't go public. So the Russell is a little bit different today than it was back then. It's, I mean, just think like SpaceX. Like, why isn't SpaceX, wasn't that public from
If it
years ago?
was
It's
more
private.
profitable, Elon probably would have done it already.
Well, but that's how it used to be. I mean, you used to have these companies that would work their way up. They'd be in the small cap. They'd be in the mid cap. They'd be,
Yeah,
look at
it's
Apple.
almost like a
Apple was,
gauntlet, right? Yeah, it works its
yeah.
way, and it's almost like minor league ball versus major league ball, right? And you get sent up, you get sent down, depending
Like
on.
Apple, if it was today, Apple wouldn't go public until it was much, much bigger. They would do private funding. But all right, I got lost track. All right, let me get back on track here. All right. So, a couple of the things, and then we're going to talk about for the options people a little bit of how implied volatility actually causes market flows. But first, long waits between cuts can be quite bullish. Ryan Dietrich put this out, and it was the date of the first cut. Let's see. Oh, no, date of the next cut. So when the Fed waits between 5 and 12 months, every time but one, when there's been at least 5 to 12 months between the last cut and the next cut, all but one time the market was higher. And so the point is, it's been 9 months in between cuts. And the question is, this isn't necessarily bad based upon historicals. This only goes back to 1970. When it didn't work was January 3rd of 2001, 7.6.
So from 2001 and 2002, you had the dot-com bubble.
That's right. It
Yep.
was next 3 months was down 18%, next 6 down 9.5%, next year was down 14%. That was a 3-year bear market. But yeah, I mean, you look at these. So 90 point, I don't know, let me see. Next 6 months. Yeah, 90.9% of the time, markets are higher. I'll let you know when I know. But the other part, let's give a bearish point here. This is from Ryan Dietrich too. Good for him. He's putting stuff out on Twitter. The weak part of post-election years is now. Average post-election year for the S&P 500, 1950 to current. And you can't see this, but we've got a chart of year-to-date 2025 S&P, and then an average of all since 1950, the post-election years. And what you see is there's an upswing, and then sort of this August, September into October, seasonally post-election year, you have this drifting lower in share prices. So, I mean, look, today definitely didn't sync up with that, but some people said, oh, wait a second, are we starting to see, we have had 6 straight days in the NASDAQ down. We're starting to see this little wavering. Maybe, but this does coincide with, I mean, August, September is seasonally some of the weak months. Doesn't mean they're all weak, but I don't know what to do with this. Just to say that if markets drifted here for a while, it wouldn't be unprecedented. All right.
I don't disagree at all. I mean, we started off the year at like 5,900 essentially. You're up 10% on the year right now with where you're at in the S&P. So guess what? You did it. You're in line with the annual average. And so a slight pullback between now and October, and then a lift through the end of the year, you're looking at being right in line with, again, annual average. So I don't think anything like that is unreasonable at all.
All right. Let's talk a little bit. I'm hesitating to do this, but why not? We'll talk about Vanna. So people are familiar with the Greeks. You have delta, gamma. So let's just go through them. Your delta is for every 1 point change in the stock. How much will the option on that underlying stock change? Your gamma is for every 1 point change. How much will the delta change? Then you have rho, which is for every 100 basis points of change in interest rates. What will the options price change? That's one's doesn't activate as much, right? That's a little of all the Greeks, that's the least considered one. And then you have vega, which is for every 1% change in implied volatility, what does the price of an option change? So you have these Greeks, then you have these second order Greeks. And Vanna is how much an option's price will change for every, let's call it 1% change in the implied volatility. So Shane, what I want to do, and then we can kind of get into some of the reasons why this actually makes sense as something that can drive the markets, is I want to set the stage. So imagine we have a completely fake stock, $646, and we're looking at a $600 put strike. And we're going to say, with the risk-free rate is 4.3%, 31 days to expiration. And if the market, let's say a volatility was, I don't know, 19.27%. Well, we know what the options price is going to be. It's going to be about $1.30, and the delta is going to be 8. So Shane, I am a retail customer trading on my couch in Oradell, New Jersey. Why Oradell, New Jersey? It doesn't matter. So, and I'm by the way, I'm in Arizona, not in Oradell, New Jersey. But I'm on my couch. I decide I'm going to buy that 600 put. You, Shane, as the market maker, have to hedge that. The delta is 8. If I buy that one put, that $600 put, what do you have to do?
I have to hedge that delta by either taking another position in the options market that is long 8 delta, or by purchasing the underlying 8 delta worth.
Shorting the underlying.
Shorting the underlying, sorry.
Yes, shorting the. So now you're short 8 shares of stock. You're short 8 shares of stock. So I'm trading on my couch. You're the market maker. You are short 8 shares of stock. Let's assume your other book hasn't changed. So now let's imagine same day something crazy happens in the market and the implied volatility goes from 19.27% to 50. And you say, well, why would it do that? It doesn't matter. Just work with us on the example.
Geopolitical stuff.
Doesn't matter.
Whatever. Yep.
So now what happens? That option goes from $1.30 to about $17, and the delta went from 8 to 27. I'm still holding that option. You're still short the option. You are short 8 shares. Shane, a new delta is 27. What do you have to do to fully hedge this?
Well, my delta got even bigger, so I'm going to have to sell even more.
So now you're shorting into a declining market, most likely, because let's be honest,
That's
probably don't get a
all
50
rises you till yeah.
So now you're shorting. So think about this. You have a market that probably is going down. Volatility is popping. You, the market maker, have to short more shares, and you are shorting
Yep.
as the market's going down. You are pounding the market lower because you're shorting more, right?
Yep. It's like a feedback loop. The market's selling off and the market makers are selling off.
Same day, whatever the fear was, I mean, this is an egregious example, but whatever the fear was, Shane, we go back to a 19.27% implied volatility. So now what happens? The delta goes back to 8. You were short 27 shares. When the delta goes back to 8, what do you got to do?
I got to buy them back.
You got to buy more shares. So now as the market's going up, implied volatility is shrinking, it's almost like a short covering rally. So you are pounding the market to the upside. You're buying more shares and you're accentuating the rally higher.
Exactly. Squeezing. And that is exactly what I wanted to sort of pin this rally this morning to. Now, obviously, I think Powell sounding dovish didn't hurt the directional move that was made in the market, but at the same time, it seemed like as soon as he kind of confirmed, everybody was, happy with what they were hearing. The vol dropped out almost instantly in the market, and what that does is it causes this massive adjustment to the dealer's book all at once. And when a move like that in vol happens, you typically get a massive covering, like you just said in this instance, right? This squeeze higher. Sometimes it's covering in the opposite direction and selling, but that's why I think you saw the move that was made today. Essentially, everybody was positioned in a manner where as long as vol dropped out, the market was going to lift higher naturally through the fulfillment of the dealer hedging their book.
That Vanna, I mean, it's the classic definition is how delta changes in response to changes in implied volatility. Yeah, I mean, implied volatility is such a used component of option pricing. Like it's sort of the main component. I mean,
Absolutely. It's our certainty on where or our confidence in terms of where we're going to trade. It's how you price it. It's the core component.
Don't you think that? So let's think about this too. Imagine somebody who's very bearish, and they're either short stock or they're long puts. Just as an easy
As
way
a
of saying it.
short delta position. Yep.
Yeah. So all of a sudden, let's say I'm totally bearish coming into today. I'm off sides. The market starts to rally. I either have to close my short, which could be short covering rally, feeding into the buying, or I take off my puts. And Shane, if I take off my puts, do you even need to hedge at all? You take it all off, right? You buy it all back.
Exactly. And that's Um, Again, I preached this when I did my podcast over at Schwab. Um, you know, this whole relationship between market participants putting a position on, the dealer hedges, something then happens, the market participant does something, then the dealer, it's just this ebb and flow back and forth, reflexive relationship between everybody putting something on or taking something off and the market maker's adjustment to that. And I think there's an argument that process is sort of why that fulfillment of the market naturally trending higher um, sort of happens, right? Um, Based on just the day to day, month to month, quarter to quarter, year to year sort of um, management of positions and across everybody who participates in the market. But
The other thing, I didn't look today at the screen on this, but there are these inflection points where there's a collection of people who are long options or short options. There's these,
the J.P.
and
Morgan collar, yes, yes,
but I mean, on a day like today, when maybe there were some out of the money calls, all of a sudden, as the market goes up, if there were a collection of calls that had lower deltas, as the market goes up, even though you get that vol coming back in, the market price moving up, if you've got a bunch of calls that are sitting there, those deltas rise because they go closer to the money or in the money. And in the money option or at the money option is 50 delta, where you have other ones that are out of the money. So naturally, when you have these sharp reversals, sometimes there could be some changes, and dealers all of a sudden say, "Oh, actually, I have to buy more stock to hedge." Meaning, me on my couch, I'm long a call. The dealer looks at their book, but in a vacuum, the dealer says, "Well, I'm short the call, so I have to buy shares as opposed to shorting shares." In the case of me buying the put, and as the delta goes higher, they have to buy more shares. So you have short covering, you have market makers potentially having to buy more shares. Now, we're not in a vacuum, Shane, and the reality is orders are coming in all the time. Some positions offset others. Sometimes
of
the
course,
dealers might say, I'm just going to carry it because I know this is coming or that coming.
yep.
But, you know, there's a reason why sometimes you look at net positioning. I think, by the way, I'd have to double check this, but I thought the commitment of traders on Russell 2000 futures was pretty bearish coming into today, but I have to double check that.
Yeah, so Vanna for me, Vanna, I it's not always relevant. Does that make sense? It's relevant when you have these big events where vol is heavily priced in and or vol isn't priced in at all and then it expands, right? So realistically, when vol is underpriced versus what ends up happening, or vol is way overpriced, implied versus realized. And we got into that too, right? We talked previously about how April was a lot of implied vol being out of line with realized vol. Implied was not in line. And that's where things can get ugly because the book is sort of like they're coming in every week pricing stuff and they're wrong. And because of that, that typically causes more volatile movements. In April, even within sort of the bottoming and the pulling back up and out to where we are now, you saw candles, daily and weekly candles throughout the month that were just massive movements up and down. And again, that is because of, right, the dealers having to violently hedge their book back and forth because they're so off sides on what they're pricing in versus what's actually taking place.
All right, I think I want to wrap this for the
Okay.
audience, and it's when you think about this, and I'm glad you brought up April. It's kind of like this. Here's the cycle. You think VIX is where it is. You get a VIX spike. which means volatility is going higher. If you think about April, that means as people are rushing to buy protection and volatility is jumping, the dealers have to short because they're hedging. And then as volatility comes back down, even if the price of the underlying S&P in this case doesn't change, they have to buy back shares because they don't need to hedge as much and I think that's the main thing. Volatility is a big component. Volatility going up can cause deltas to change. Volatility can go down. Going down causes deltas to change. And deltas is kind of relating to the hedges. So, all right, we got through Vanna. Shane, any recommendations this week, by the way?
Yeah, absolutely. Book wise, I have picked back up my Daily Stoic. I read it for a couple years in a row every day and picked it back up. I love it. I think Stoicism is a very, very sort of compatible philosophy to have if you're going to be investing or trading. I think that's just, it's good to practice, or at least, you know, be aware of that sort of mindset.
Who's the author on that? Is it Ryan Holiday?
It is, yes, Ryan Holiday. Yep, and it's a lot of Marcus Aurelius, right? I mean, that's majority of it's from Meditations, but it's good stuff.
All right, for the philosophy fans out there, I'll throw out a book, "The Shortness of Life," Seneca. Very very short volume, but it's pretty good as well for those of you who like philosophy. So there you
Nice.
go.
I got one to order here. I think the last one by any of those, I ordered my youngest brother, Allegory of the Cave. He's finishing up his computer science degree or cybersecurity degree at Iowa State right now, and I was like, it's time you read this if you hadn't. So I look forward to hearing what he says about that one.
Ryan Holiday, by the way, so he's got the obstacle is the way, ego is the enemy, stillness is the key. It's a good example of somebody who just picked a niche and is like, I'm just going to really go into this niche.
Yeah,
So,
yeah. No,
all
I
right.
mean, modern. It's really nothing new, right? It's not like he's
Because
coming up with anything that hasn't already been written or known. It's just he's expanding on it, and I'm glad somebody's doing it.
Well, I'll be honest too. Like even Seneca, The Shortness of Life, the now the philosophy aficionados out there will hate me saying this, but some of these books are very old and they're written in ways that we're not used to right now. So I think what Holiday and others who have done these adaptations, they've done a good job of sort of making them very readable. I know it's blasphemy to say you shouldn't read the original text, but all right. Any other books? Any other movies? You got any shows?
I think we are going to start Billions next. I'm not
I can't believe you
officially.
haven't seen that yet. For God's sakes.
Isn't that crazy that I haven't seen? But I started it in college, and I don't know. I just fell off. Didn't follow through, and so look, we finished The Sopranos. We've been thinking, what are we gonna do show wise? We needed something to pick up, and I'm like, I gotta watch Billions. So that, and then I gotta watch Argo. I am so sorry that I
Oh yeah,
failed that
Argo.
this week. Right? I have seen Miracle. I remember going to see that with my grandparents actually in theaters when it came out, and that's one of my favorite movies. Kurt Russell, phenomenal. Um, but yeah, I got to get Argo down as well. So
I
that's on
remember
the list.
watching the game, and
Chilling. It had to. I mean, I got chills watching videos of the game. When I first saw it, it's just
the crazy thing was like I remember. Yeah, I mean, I was pretty young, but I remember like jumping around when they won, when they beat the Soviet Union. But it was just so odd. I mean, there was no internet back then, no nothing. There was no way to know the score. That game was shown on tape delay. I think it was 8 o'clock New York time. They showed it, but it had been played at 5,
that's
and
still
nobody
pretty
knew the outcome.
impressive. That's still pretty impressive though, and everybody was still on the same page outside of who was there in attendance. Um,
Well, in,
that
in hindsight, though, I remember. So Jim McKay is the famous anchor for ABC. There's been books written on. He's pretty famous. But Jim McKay was at a desk, and it was outside in Lake Placid, and I remember people were just like really excited behind him. But he was doing the pregame show on a game that had already been played. And in hindsight, it's like, oh yeah, they already won. That's why people are celebrating so much. It's interesting. I love the movie. I love Miracle, and but Argo is the same time frame. And Ben Affleck, I mean, I think he didn't win an Oscar for his performance, but I think he won an Oscar for directing or producing. Maybe the producer, he got it. He probably should have got it for directing, to be honest with you. But yeah, all right. So that's a good recommendation. I mentioned to the audience last week, I watched on Apple TV Plus Stick with Owen Wilson. He's kind of a washed up former pro golfer, and he decides to try and he finds a young golfer to try and mentor and tutor, and it was entertaining. I'll put it, it's not my conviction list, but I'd give it a buy rating. I would watch it.
Hey,
So,
I mean, in this day and age with television, movies, I'm pretty critical of my buys, so I think you are too. So I have to check it out. I mean, sounds like a good story.
it's not bad. It was a little corny at
Little
times.
funny, like a little funny, a little serious.
Owen Wilson was doing his Yumi and Dupree character from that movie.
Yeah. No, then that's fine.
Yeah.
One of my favorite, what he was in the.
Oh, but here are the keys going. You're looking it up.
I am. Hang on. Grand Budapest Hotel, right? And what was the other one? Royal Tenenbaums. Those are some of my favorites.
Gene Hackman was in Royal Tenenbaums.
Royal Tenenbaums is such a great story. The Jarling Limited. That if you haven't seen the Jarling Limited, fantastic movie.
All right, we got plenty of books, plenty of movies to see, and TV shows. Of course, the greatest show is the stock market. I mean, Nvidia is not next week, but it's coming soon. So, all right, Shane, good discussion today. Thanks for coming on as always, and for everyone else, we'll talk to you next week. See ya.